Today, we're going to tackle a question that sounds like it belongs in a physics class, not on a trading floor. And that is, can the wild, seemingly chaotic world of the bond market actually be described by simple, predictable patterns? Well, you're about to see why the answer is a pretty surprising yes.
I mean, think about it for a second. Some huge announcement hits the wires, the Fed cuts rates, there's a surprise tariff, some big geopolitical event goes down. We tend to imagine the market reacting instantly, right? Like a perfectly vertical line on a chart. But is it really that simple? What's actually happening in those first crucial seconds and minutes? Is it just pure chaos, or is there some kind of hidden order to all that madness?
Reality is actually way more interesting. So, what we see is an initial instantaneous jump in bond yields right when the news breaks. But then something else happens. The yield doesn't just lock into its new spot. It often keeps on drifting, kind of gradually approaching a new level over the next few minutes or even hours. This two-part move, the jump and then the slow drift, that's the puzzle we're here to solve. Now, to understand this, we're going to borrow a concept from a totally unlikely place, control theory. Yep, this is the world of thermostats, of cruise control, of industrial engineering. And the core idea is that the bond market might behave less like a panicked crowd and more like a predictable physical system. This brings us to the main event, a first-order lag system. Now, I know it sounds super complicated, but the idea is actually pretty simple. It's any system that reacts to a sudden change, not by snapping instantly into place, but by smoothly and gradually adjusting over time, and, this is key, without wildly overshooting or bouncing around. Think of a car's shock absorber smoothing out a nasty bump in the road. That's a perfect real-world example of a first-order lag system doing its thing. So what are the key ingredients here? Well, first, you get an input. That's our news event. Then, the system smooths that input. It absorbs the shock without bouncing all over the place. The response lags behind, kind of gradually catching up. And crucially, this whole process is governed by a single magic number, the time constant. And that number defines the system's unique reaction speed.
Let's just zero in on that time constant for a second, which is represented by the Greek letter tau. Now, this isn't just some vague idea of speed. No, it's the specific amount of time it takes for the system to get about 2/3 of the way, 63.2% to be exact, to its new equilibrium. So a short time constant means a really fast reaction. A long one means a slow, gradual adjustment. Simple as that.
Okay, so how does this engineering concept actually apply to the bond market? Well, the theory goes that different bonds, specifically bonds with different maturities, like a 2-year versus a 10-year, they act like different kinds of filters for information, and each one has its own unique time constant. Here's the best way to think about the difference. Short-term bonds, like the 2-year Treasury, they react super fast. They've got a short time constant. They're like that shock absorber we talked about, responding immediately to news, but also recovering quickly from any temporary jitters. But long-term bonds, like the 10-year, they are the complete opposite. They have a long time constant, so they react more slowly and steadily, filtering out all that short-term noise to focus on the real long-term signal. So what does this actually look like in practice? Okay, imagine a surprise economic announcement hits. The 2-year yield is going to jump, and jump sharply, and then it's going to rapidly start to settle back down. The 10-year yield, on the other hand, will have a smaller, more muted initial reaction, and that's followed by a much slower, more gradual drift to its new level. You see, it's absorbing the exact same information, but it's processing it on a totally different timescale.
Okay, so this is a really compelling theory, but does it actually hold up in the real world? I mean, for real. To find out, researchers dug into high-frequency data from actual market-moving events to see if this pattern is really there.
And what they found is, well, it's pretty remarkable. This first-order lag pattern shows up again and again, consistently, across a huge range of events. It doesn't matter if it's a Fed decision, a new tax law, a tweet about a trade war, or a massive geopolitical shock like Brexit. The market response follows this same dynamic of a jump, followed by a smooth, gradual adjustment.
Let's take a specific example. August 1st, 2019. An unexpected tweet announces new tariffs on China. Bam! The 10-year yield immediately drops. But it didn't just stop there. Over the next hour, as traders and algorithms started digesting the long-term implications, the yield actually continued to drift even lower before it finally stabilized. That right there is a classic first-order lag response playing out in real time. So to kind of sum up the findings, researchers were actually able to estimate the typical time constants. For a 2-year Treasury, the adjustment happens on a scale of minutes to hours.
But for a 10-year treasury, it's a much slower process, taking hours, maybe even days. And this just confirms it. Different bonds really do act as different information filters.
So why does any of this model matter? I mean, okay, it's a cool theory, but so what? Well, because understanding it gives us a really powerful new lens for looking at market behavior. It helps us see a predictable signal that's hidden inside what just looks like random noise. And that has some very real practical implications.
The reason for this smooth, controlled response comes down to a concept that engineers call a high damping ratio. And what that basically means is the bond market has these powerful built-in safety brakes, things like arbitrageurs and risk management rules that prevent these wild, oscillating overreactions. So unlike, say, a bouncy spring, the market is heavily damped. That ensures that when it gets hit by a shock, it adjusts smoothly instead of, ringing like a bell.
So the crucial point is this. First, market reactions aren't just noise. They contain a predictable signal. Second, different bond maturities act as different filters, absorbing shocks at different speeds. And finally, and this is probably the most practical part, if you understand this pattern, you can actually gauge in real time how the market is interpreting an event. If a yield doesn't start reverting back like you'd expect, that's a huge sign the news is being treated as a permanent shift, not just some temporary blip. This quote from the research just captures the essence of it all perfectly. The idea that this massive, complex market processes information with the kind of controlled response you'd expect from a physical system with inertia and friction, that's a really powerful thought. It's a beautifully simple analogy for an incredibly complex world.
And all of this leaves us with one final thought. We always hear that markets are a random walk, or that they're just pure chaos. But if they follow these predictable, almost physical patterns in response to news, what does that really say about the nature of market randomness? Maybe the key to navigating the chaos isn't trying to predict the unpredictable, but instead learning to understand the predictable patterns that emerge right in its wake.